talk about accounts receivable, and what we want to do is we want to break it down into two categories for this chapter. We're going to talk about how to account for accounts receivables initially record them on the books and how they are affected when they're reported. But we also want to separate it from how it subsequently is handled once it's already initially recorded. And so we're going to talk about the upfront procedures in terms of how to handle accounts receivable. And then we're going to talk about the back end procedure, particularly on collectibles. Okay? And so on the upfront, how do we initially record receivables? We basically have two methods in which we can do it. We have the gross method and the net method, okay? And so what we're going to do is do a quick example of the difference between the two. And basically what you need to understand is that under the gross method, accounts receivable will always come on or go off the books at its gross amount, its full amount, okay? In contrast to the gross method is the net method, which dictates that accounts receivable, regardless of the situation, you will always increase it or decrease it, put it on the books or take it off the books at its net amount, net of the discount being offered. So regardless if a person is taking a discount or not, you're going to initially record accounts receivable as if the discount was taken. You're going to always take accounts receivable off the books as if the discount is taken. So they're two opposite parallels. One, you're going to always touch accounts receivable, put it on or off the books at the full amount. The other, you're going to obviously decrease accounts receivable through the discount, regardless if it's ever taken. All right? So let's see how they go by differently. Okay? So let's say it is May 1st. You guys see that? Let's assume it's May 1st. And suppose we sold $10,000. We sold inventory, let's just say inventory, on account for $10,000. And right now, for simplicity, we're going to ignore the cost of the inventory and the journal entry that's affecting inventory and cost of goods sold, because I'm just trying to get to my point in terms of accounts receivable. So let's just leave it at that. So on the first, we sold inventory on account for $10,000, discount terms $210, net $30. All right. So how would that be reported under the gross method? Well, we know when we sell on account, we debit accounts receivable, and we credit what? Sales revenue. However, depending on the method is going to dictate. Depending on the method is going to dictate how the amounts are going to go in, right? The gross method rule of thumb says accounts receivable always go at the full amount. So the full amount is obviously $10,000. Of course, we're going to credit sales revenue for the following $10,000 as well. Okay? Now, in contrast to that, if we had to take that same transaction and use the net method, how would that affect the journal entry? How would the journal entry be affected? So, under the net method, we still would debit accounts receivable, and we still would credit sales revenue, but our amounts would differ, right? Because the method dictates that. So instead of us putting $10,000, which would be equal to the gross amount, we're going to have to take out the discount, right? So the discount is $210, net $30, and so we're going to assume that they already took the discount out before we even give them a chance to pay. That's the net method rule. So 2% of $10,000, what is that? $200? So we're going to take the $200 out, and we're going to debit accounts receivable for $9,800, as well as sales revenue for $9,800 as well. Make sure you guys can see that. Okay. So moving on, let's assume that it's May 3rd, and suppose we collect $4,000 on account. Suppose we collect $4,000 on account. Okay, so obviously we are still in the discount terms because it is May 3rd, right? And May 1st is when it initially happened. So let's see how that's going to affect things. When you collect on account, regardless of the method, you always debit cash and you credit accounts receivable. So that won't change between the two. But we know that because a discount is being given, our cash will be less than the actual value amount, right? And so 2% of the $4,000, that gives us, what is that? $80, right? So we have to take $80 from cash. So we can take 4,000 minus 2%. And that'll give us, what is that? 3,920, right? Now, how will we record accounts receivable? Well, it's the gross method. So account receivable has to come off the books at the gross amount, the full amount. The full amount is $4,000. Even though a discount was given, the full amount was $4,000. So as you can see, our debits and credits won't equal. And we have just given a person a discount, so we're going to have to debit sales discount. We already know sales discount is a contra account to sales revenue. So now our revenue is adjusted appropriately. So the $80 is going into sales discount, and again, it's going to follow sales revenue, so we can have everything as a systematic way of accounting for accurate revenue. So how would that differ under the net method? Well, because the net method tells us that we've already taken a discount out, we're going to debit cash for the $39.20, but we must also credit accounts receivable for the $39.20 as well, because the net method tells us, regardless of what's going on, accounts receivable always comes off of books at the net amount. Net amount. Okay? So now let's take a look and see how this would be affected if the next collection was outside the discount term. Let's say May 15th. Suppose we collect the remaining amount on. Suppose that we collect the remaining amount, right? Suppose that we collect the remaining amount, okay? And that's on the 15th. That's outside the 10 days of the discount, right? And so we need to know how to adjust that accordingly. So in terms of our gross method, still going to debit cash, we're still going to credit accounts receivable, that won't change. Gross method dictates that the gross amount will still come off the books at the full amount, guys, full amount. So we started out with accounts receivable at 10, and we reduced it by 4. So our remaining is what? 6, and 6 is the full amount, right? Now because this was outside the discount terms, our cash will not be affected as well. They have to pay the full amount in cash. So simply, we're going to have a debit to cash and a credit to accounts payable for $6,000. But how would that differ with a collection on the account outside the discount terms when you're practicing the net method? When you're practicing the net method, again, we're still going to debit cash, and we realize at this level that no discount was given, so our cash will equal to $6,000. But the rule of thumb dictates that we have to credit accounts receivable at its net amount, net of the discount, even though it wasn't being taken out, right? And so we have $6,000, We have 20% of, 2% of $6,000. That would be 120. So we're going to take $6,000 minus 2%, and that's going to give us 5,880. 5,880. Obviously, our debits and credits do not equal again, and we know that the difference between this has to come into another account. Now, logically, what's going on is we expected these guys to pay within the discount terms, and they didn't. So technically, we're going to treat that as interest. So that's why we're going to credit interest revenue for the 120. Thus increasing our revenue account appropriately through interest. All right? So those are the two methods in which we could initially record accounts receivable on. So make sure you understand those because it will affect your financial reporting. Okay?